So who better to have on than Mark Fields, former CEO of Ford, CNBC contributor. Mark, kind of a rapid fire here. We're going to ask you about some couple different stories and kind of go bang, bang, bang. First off, these bankruptcies and some other stuff, but I want to start with General Motors because you and I have talked for a couple years about EVs. It's really hard. Tesla's got a big head start. GM taking a $1.6 billion charge related to EVs. I think they're doing okay. Anecdotally, I see more on the road, but what's your take on this story?
Well, as we've discussed, Brian, over the last couple of years, the automakers really went full bore in putting in capacity for EVs. And they really didn't have a good discussion on the consumer in terms of what it was going to take to get the consumer to buy these EV products. And you've seen a lot of capacity go in. And what you've seen over the last 18 months or so is some of these bets went wrong. You saw GM's announcement today of impairment of about $1.6 billion. They noted that there could be more to come, and I think there are. So you're going to have a lot of stranded capital. Ford had last year, they took a $1.9 billion charge for canceling an EV program up in Canada. And so this is clearly an issue where the market didn't develop the way the automakers thought. And a lot of them, particularly in GM's case, they boasted that they had the full lineup of EVs. And what was an advantage, at least they thought at the time, has now probably turned into a bit of an albatross as the market take-up of EVs is going to be lower, at least in the near to medium term, than they planned for.
Listen, you and I talked about it 2 years ago ad nauseum. We probably both took a lot of heck for it, but we've been right on the mark, Mark. All right, story number two. It's a little wonky. Call us WBI, wonky but important. There have been two big bankruptcies in auto parts, a company called Tricolor, a company called First Brands. Leslie Picker just referenced them in the Citigroup CFO interview. First Brands in particular is really rocking parts of Wall Street. I don't want to get into the whole story, but how big of a deal is this?
Well, I don't think it's a huge deal as it pertains to the auto industry. I do think it's a big deal when you look at credit and how credit's been taken out over the last couple of years. I mean, in the First Brands case, this is really about a story of over-leveraged growth, opaque financing, refinancing, and it seems like governance and accounting issues. And, when you have a company that depends heavily for growth on acquiring companies, plus layers of debt, plus off-balance sheet, complex financing, it's very sensitive to things like changes in credit conditions, interest rates, consumer, and you've had disruptions in each one of those. And, this is a case where they took out a lot of debt. And Brian, as you know, when a company, part of their financing strategy, core to their financing strategy is factoring receivables, that's a really big red flag because, a company normally doesn't want to give up any portion of their receivables and they'll collect them themselves. But I think in this case, and we'll see how it plays out, I think the growth of private credit is playing out here. And I think that is what's getting a lot of attention on Wall Street because private credit doesn't necessarily have the same kind of, stringent requirements that bank debt does. And so I think this may be a little bit of the canary in the coal mine as you look at over-leveraged companies that are having margin and growth pressures.
The First Brand story just gets weirder and weirder, but we're going to move on. Story number three, some new data out that car loans, Mark, are being paid later. Repossessions, they are on the rise. They have been for a couple of years, but they keep going up. The average price of a new car is like 50 grand now. Is the consumer finally starting to crack under the weight of, $1,000 a month car payments?
Well, you're right, Brian. I mean, it was reported yesterday that last month, the average selling price in the industry was over $50,000.
Wow.
So I think you're starting to see the confluence of, the automakers have done a good job in trying to absorb a lot of the tariffs. But as the new model year comes in, I think they're looking at opportunities to kind of raise the prices and maybe decontent the vehicles to keep the prices down. But, when you look at the payments, an average payment now on an auto loan is over 6 years and it's over $750. That's up from about $570 pre-COVID. I don't think when you look at the bankruptcy of Tricolor is kind of impending doom in the auto industry. And the reason for that is when you look at subprime, it's still a relatively small portion of auto financing. The banks, as well as the auto company, finance companies have tightened up their standards. But, it's not a foregone conclusion that, weak performance in subprime auto loans and, in any way, shape, or form signals doom for the U.S. auto industry. But it's a legitimate warning flag. And that's why you're seeing only wealthy people being able to afford vehicles these days, new vehicles.